for people, and I can try and switch to another audio source. Let's just see what someone says, but I guess maybe I'm not coming through quite so clearly, or perhaps I am. We're hearing it loud and clear, so that's good. I'll take that as a positive sign. Um, so my name is Eamonn Carey. I'm the managing director at Techstars in London. So what I'm going to do today is tell you just a little bit about Techstars and why I'm talking to you. I'll share a little bit of information about the fundraising process as we've seen it, and then happy to answer any questions that you have. And great to see. I think I saw people from Algeria and Benin and India and Indonesia and all over the world. So it's a real pleasure to get to talk to you. So this is me on Twitter. If any of you want to catch up with me or share any information or ask me any questions afterwards, I'm pretty easy to find. So let me start and tell you a little bit about Techstars and what we do. So Techstars is a worldwide network that helps entrepreneurs succeed. And we do that in a whole bunch of different ways. We work with companies around the world to connect people to founders, mentors, investors, partners, various different people who can help give entrepreneurs an unfair advantage. And we do that at every stage, from inspiration to IPO. So we run events like Startup Weekend in 168 countries around the world, where we bring people with ideas and plans for startups together with people who can help with building those companies and scaling those companies. And over a weekend, they build a prototype for an MVP. We run Startup Week around the world to help people get connected to the entrepreneurial ecosystem in their country or in their city, so they can meet with startups, meet with companies, and understand how to get involved. We run Startup Digest, where we share lots and lots of information about various different topics, artificial intelligence, blockchain, lots of others. So you can take a look at all of these on the Techstars website and find out a little bit more. We also run accelerator programs where we invest in companies. So we've now invested in over 1,500 companies from all over the world. Over 10,000 mentors help our companies and support them as they grow and scale. We've worked with thousands of investors and thousands of founders from around the world. We now run 43 programs around the world where we invest $120,000 into companies. We put them through a 3-month process of meeting lots of mentors and partners, execution, meeting lots of investors, and hopefully help companies to grow and scale and do interesting things. Big corporates to do this as well. So one of the big ways for companies to succeed is to partner with bigger companies. And so we work with great people like Rakuten or SAP, PwC, or Accor Hotels, and many, many others. So these are just some of the folks that we work with around the world. We're also a venture capital fund. So we've invested in some companies which hopefully you've used or heard of over time. SendGrid here, a company that went through one of our accelerators and subsequently had their IPO last year. Successful, so about 80% of the companies that go through our programs go on to raise follow-on rounds of fundraising. So we have witnessed a lot of fundraising rounds and seen a lot of companies go through the process of raising capital. And we've invested in everything from fintech companies to food tech companies to AI companies, and I think a little bit of everything over the last few years. We had over 1,200 people apply for our program from 77 countries, and we picked 10. So we have 10 new companies who will be starting Techstars London with me here next week. So through a few topics. I should say these are some of the amazing investors that we've worked for. So when we're assessing companies, these are some of the things that we think are really important for people to think about. And apologies if the sound is not great for some people. It seems to be working for some and not working for others. So what we look for when we're looking at companies is the really crucial thing is the team, the people who are part of the company. So these are the 6 things that Techstars looks for when we are looking at companies to invest in. It's team, market, progress, idea. And so when we talk about team, what we mean is we want good founder market fit and real passion for what you're working on. I think it's really important for founders to be working on a problem that they're feeling internally and feeling kind of painfully themselves. It's really important for there to be some unfair advantage that companies have or that individuals have as well. And so, team is one of the most important things. We also want a balanced team. So we want to have people who can work on development and technical execution, as well as building and scaling the company. So having a balance of technical talent and executional ability is really important. We obviously want to invest in big markets and growing markets. That's very important for us. I think we like to have some degree of traction over time. So that doesn't have to be users or revenue. It can be, signups to a mailing list and various different people kind of getting involved in your companies. Masood has asked, do we invest in seed stage? Absolutely. We invest in every stage, actually. And really then kind of the traction is not as important as it might be for some investors. And then the idea is almost sometimes the least important thing that we invest in, because we know that lots of companies will pivot and they will change their company and their product and their idea as they go through a program or as they go through their journey as entrepreneurs. Answer your question, we're stage and sector agnostic. We invest in teams of 2 to 20 people across every sector: fintech, agri-tech, food tech, IoT, hardware, software, smart hiking backpacks, Waleed. We've invested in everything. We've invested in toys, we've invested in video games companies, we've invested in machine learning companies, we've invested in business to business and business to consumer companies at every stage. And we've invested in companies that are pre-product and pre-revenue. We've also invested in companies that have been generating, millions of dollars in revenue. And we invest in companies all over the world as well. So the next batch of Techstars London companies, we have 3 companies from the UK, 1 from Finland, 1 from the US, 1 from Portugal, 1 from Korea, 1 from India, and 2 from Ukraine. Talk a little bit more about investments, and then I'll come back and try and answer some of your questions. So what everyone wants when they start a company is for some number to go up very quickly, whether that be your number of users or the amount of revenue that you're generating. But everyone wants what they call a hockey stick curve, so some sort of growth very quickly over time. The reality is that it's a very tough and very different process. There are very few startups that have that massive growth curve and never get off it. For a lot of companies, they launch and then things don't go so well for a while, or they plateau, and sometimes things don't work out. Sometimes a lot of opportunities will present themselves for things to work out. So it's a very difficult journey, but it is one that is particularly interesting at the moment. And that's because this was the very first site that was put on the internet in 1991. And that's, if you think about the amount of great companies, businesses, and wealth that has been created in a very short period of time since this first website went up, it's huge. We're only 10 years into the mobile revolution since the iOS and Android Play stores came into being. It's very early days in blockchain. It's very early days in machine learning and computer vision. It's very early days in voice recognition and lots of other areas. So to me, there has never been a better time to start a business. There is a lot of investors and a lot of capital out there that's looking for great opportunities, on all corners of the road. So it's a great time to start a business. But there are some things you should be aware of when you start a business, and some things that you need to think about. The first one is to think: do you actually need to raise money? Venture capital is a very unusual thing. Raising money from investors is extremely unusual, and it's a very unusual way to grow a business, and it puts a lot of pressures on you that maybe it's difficult to understand in the early days. So not every company needs to raise money, and this is important to realize that the goal of the company should not be to raise capital. It should be to grow a great sustainable business that solves a problem for people, and maybe makes their lives better or more fun or easier or faster or any of those things. The first company that I started, we never raised money. There were no investors or angels or accelerators in Ireland 20 years ago. I built a product that people wanted, and I asked them for money for it and sold the product to lots of people. And when I made some money, I used it to hire more people to build better versions, and grew my company that way. So not every company needs to raise, and you need to be aware of some of the pitfalls and potential areas of risk when you deal with VC. So do think very carefully before you go down this road, because it's a long one and it's difficult, and we'll understand why through this. I can see the questions here from Amit and Charles. I'll come back to them at the end of the presentation, if that's okay, and some of them we'll answer along the way. So not everyone needs to raise capital is the first thing to say. The second thing to say is that if you are going to raise venture capital or investment money, don't just think that you can start at any time and in any place. There are, in different parts of the world, a whole pile of restrictions in terms of when people will invest. And so if you think about Europe, the United States, big chunks of the Middle East and elsewhere in the world, a lot of the months around the summer and the kind of start and end of the year, people are on vacation, there are holidays, there are lots of things going on. And so a lot of investors just won't engage, or if they do engage, they won't send money, or they won't have time to take meetings, etc. So it's good to understand kind of the calendar in your region, and understand, are there specific times of the year where it's better to raise capital? Are there specific times of the year where people tend to be away or on holidays, or any of those types of things? I think it's important to understand what you're going to need to talk to investors. So when we do due diligence with companies before investing, we like to see employment agreements, IP agreements, lawyers in place, that you have a deck and an executive summary, that you have your cap table, which is the spreadsheet with the details of all your shareholders in place, and a nice version of that we can read through and use. So just make sure that you have all of the kind of right documentation in place, because the more that you have that, the faster you will go through the process. Also, we see a lot of companies thinking that they'll finish their raise very, very quickly. The reality is, whether it's in the US, and I used to run Techstars in New York, one of our programs there, I've been involved in accelerator programs all over Europe, Middle East, and Asia. The average that we've seen is from the day that you start the process to the day that the money goes into your bank account is usually up to 6 months. So it takes a long time to get money in the door from investors. It can happen faster, but it's better to plan for it taking a little bit longer than you might expect. Not all investors are created equal. So there are a lot of people out there who say they're investors, or who say they're advisors or mentors, or people who want to help you, but they don't. They want to get equity in your company, or they want to try and do things that are maybe not helpful for you. I wrote an article for TechCrunch a little while ago about startups having to do their own investigation of investors. I think it's very important to be aware of who is giving you money or who is talking about giving you money, because sometimes if you take the wrong investor on board early on and they own 15% or 20% of your company or more, you might be stuck with them for a very, very long time. So make sure you do background checks on investors. If people want to put money into your company, ask if you can talk to some people they've invested in previously so that you can get an idea of what they're like and how they are to deal with and so forth. So it's really important to think that not all investors are the same, and not all investors are necessarily going to have your best interests at heart. So this is a really important one. Just make sure that you're doing your due diligence. This is another important one. One of the most precious resources you have as a startup and as a human being is time. Time is a unit of scarcity. We can't manufacture more of it. And I see a lot of companies spending a lot of time trying to talk to big name VCs in the United States. The reality is for most of these VCs, for most angel investors, for the vast majority of people who invest in companies, they won't invest any further than 50 miles away from where they're based. So less than 18% of the money that goes into companies around the world goes into companies that are more than 50 miles away from where the lead investor or angel investor is based. So you can spend a huge amount of time trying to get in touch with someone great at Andreessen Horowitz, and don't forget it's the VC's job to understand what you're working on, but they may not invest in, they almost certainly won't. So big name VCs are great to get involved as you go later into your company, but in the early stages, you can spend a lot of time and energy for very little results. So just be wary of this fact that realistically, if you want to open a company in London and you want to raise capital, most of the investors that you will get money from will be in London in the early stages. If you want to open a company in Dubai and raise capital, a lot of the early stage investors that you should be talking to are people in that city and in that region. So just something to be conscious of. This touches on a question that Anthony asked. I think a lot of people say that they'll figure out how much money they need to raise later on in the process. To me, this is a really bad idea. I think you need to know how much you are going to raise. I think it is really important to understand how much you're going to raise, because it gives us comfort as investors that you have thought about this whole process, that you understand how the investment process works, that you understand how the process works after investment. So what we typically say to people, and this is a good kind of shorthand to have in general, is think about how much money you need to raise for your company to last 12 to 18 months, ideally 18 months. So you need to figure out how much your salaries are going to be, how much your rent cost is going to be, how much any of the other overheads are going to be for your business, including new hires and that side of things. And think about how much that's going to cost over an 18-month period. And that's how much money you should raise. The reason that we say 18 months is usually companies will raise every 18 to 24 months. And so 18 months allows you to raise the money, focus on execution for 10 or 12 months, and then go back out and start fundraising again. So this is a really important one. Understand that 18 months number, because that's hugely important. The idea that you can just email investors and get a meeting is very difficult. Most investors have a strict hierarchy in terms of who they talk to and who they respond to and who they're interested in, which is why events like Startup Istanbul are so important, where you can have, like last year was Techstars and 500 Startups and Y Combinator and Tim Draper and a lot of great people that you can meet and use those opportunities to build a relationship. If you're just sending out a spam email to 500 investors, it's much less likely that they'll respond or engage or be enthusiastic. It's really important to try and build a relationship or approach investors where you think there is a good fit in terms of their interest and their background, and the subject or the product that you're building and the subject that you're working on. So I think it's really important not to spam people and not to expect to get great results from doing that. It's much better to kind of create personalized messages, build relationships. Don't send 10,000 page business plans in your first email. Send something very short and engaging. Get my attention, build a relationship that way. Those are all hugely important, because realistically, to raise money, we see companies talking to probably 60 to 100 people before they close a round of funding. So the idea that you can have a very short conversation with a very small number of investors and close a round, is just not something that happens realistically, unless you're a super hot deal and everyone wants a piece of you, which is a great place to be. But realistically, you've got to be ready to talk to lots of people. You've also got to have your documents together. So usually what we advise companies is to have a 10-slide pitch deck that roughly follows, this format of, who's the company, what's the problem you're solving, what's the solution, why are you doing it now, a little bit about the market size, the products, and show some product shots. The team is really important. How are you going to make money? Who else is in the market? And then some information about how much money you're raising and what that money is going to do. This is some data from DocSend, which is a really big document sharing site, and also Sequoia, who are one of the biggest investors in the world. They analyzed which slides investors looked at most frequently, and it was product, team, and competition. I think that is the most important thing. Again, if you think back to what I said about how we invest in companies at Techstars, team, market, traction, idea, those are the most important things. And so making sure that it's a great team who can build a phenomenal product in an interesting market. So just be aware that product, team, and competition are ones that people will zero in on and zoom in on very quickly. It's also important to have short pitch decks because investors see a lot of them. As I said, we had over 1,200 people apply to be part of this Techstars London program. Most good VCs and angels will see well over 1,000 presentations and decks every year. We probably see 3,000 or 4,000 pitches every year. So we don't have a lot of time to look at them. So make sure they're short, they're to the point, they get the message across, they make me excited and make me want to have a meeting with you. So just be conscious of that. They should be very short and to the point. And we'll come back, I think, to a couple of these questions again in a few minutes. And build a little CRM system for yourself. So we use a tool called Streak to allow you to just track who you've spoken to, who you've met, who you've emailed, what have they said back, are they excited, are they thinking about investing. It's just good to be able to track this because, like I say, you should expect to talk to 50, 60, 80, 100 people as part of your fundraising process, and it does become very important to manage and keep a track on that over time. The other thing is, if you do meet investors, whether it's me at Startup Istanbul in a couple of months' time, or if it's other folks, most investors are friendly. Most investors will happily have a quick coffee or a quick conversation with you. It's also important to recognize that it's our job to gather data about you in all of those conversations so that we can kind of understand, is this something I might be interested in investing in? Is this something that might be a fit for one of my friends elsewhere in Techstars or someone else that I know? So, when you're talking to investors, you have to be conscious that you're always on and that, you're kind of always having to present the best version of yourself that you can. So you're never just having a conversation. It's always someone gathering data. So just be conscious of that and be aware of that, because you don't want it to get too casual, or you don't want to say anything terrible about your product or your company that might come back to haunt you. Here's another problem. So investors hear what they want to hear, startups hear what they want to hear. So I get a lot of emails from companies that I've met saying, it's so exciting, this company is in, they're going to invest in us. And then you go back and say, oh, well, what did they say? What were they, what was the best fit? And they say, oh, well, they said, keep us informed, we're really excited about what you're doing. And that doesn't mean that they're in, it just means they want you to keep emailing them so that they can gather more data, gather more information, and maybe decide to invest if things go well. So it's in our best interests as investors to keep you engaged with us and to keep the conversation going, because we obviously don't want to miss out on any brilliant deals or any brilliant opportunities that may exist. So just important to kind of to have that in mind, that people don't always mean that the saying yes doesn't mean they're in. What we say is, investors are not in, they're not committed to investing in your company unless they have said very clearly the word yes. I will invest $50,000 in your company, and you have to get it in writing. So get it in an email as quickly as possible when people say they're interested. Right, this is really important. You need to get them to confirm that they're excited, that they're going to invest, etc. This comes back to a question someone asked earlier in terms of valuation. So typically, most accelerators like Techstars or YC or 500 startups, we usually kind of invest around $100 to $150,000. We usually take somewhere between 6 and 10% of the company. That's usually a blended investment with a convertible note at a $3 or $5 million cap. For a lot of other companies who maybe don't go through Techstars or who raise money from angel investors or VCs, you should be aware that most investors will want somewhere between 15 and 30% of your company in a funding round. And so if you remember when we talked earlier, you need to work out how much money you need for the next 18 months. Well, then you're going to be saying, let's say that's $100,000 that you need. When you raise $100,000, you're probably going to be going to give away 15 to 25% of the company. So your valuation is going to be kind of somewhere between $600,000 and $1 million. So just be conscious of this, that we see a lot of companies pitching saying, I'm going to sell 5% of the company, or I'm going to sell 8% of the company. Most angel investors and VCs don't think like that. They want to get access to a bigger piece of your company, and it's important to understand the economics and how the kind of angel market, VC market works, because in order to get the right type of return, those are the types of percentages that people look for. And that happens over the lifetime of your company. So, this is just some data from CapShare, which is a service that goes through cap tables. So you'll see here, company owns 100% of the company, then they do a seed round, they give away 25% of the company, then they do a Series A round, they give away, further 20% of the company, and so the founders are diluted down to 60%. Then they do another round of funding where they give away 25% of the company, and they're down to 45%. So every time that you raise a round of capital, you should be expecting, until you get to kind of these big growth rounds, that SoftBank and Uber and those types of folks get into, you're always going to be giving away about 20% is the average of the company. Back to thinking about investors again. The lead investor in a round is really important. So the lead investor is the person who will set the terms, who will negotiate the valuation with you, and so having someone who's really nice is quite important in that regard. Also, your lead investor is likely going to be a board member with the company, and so if you don't get on with them, or if they're not particularly good people, you're stuck with them for a long time. You're going to have board meetings with them every couple of weeks for a very long time. So, people joke, lead investors and board members are like getting married. You're stuck with someone for a long time. So just make sure they're the right person. People get obsessed about getting term sheets, which is an investment agreement. Term sheets tend to change an awful lot. Really, what we suggest to companies is what you want is a commitment with a contingent requirement. And so what that means is someone says, I will invest $50,000 in your company if you can find a lead investor who will take a board seat. I will invest, $50,000 in your company if you can get a tier one VC to lead the round, someone really big and successful in your region. Or I will invest, $50,000 in your company if you're able to sign a pilot or proof of concept with one of your B2B users, or if you get to 100,000, downloads. So that's kind of what you want to get to before you get then to that magical, yes, I am going to invest in your company email that I mentioned earlier. A few more slides, not very many. The other thing is, people think that you can run a business and fundraise at the same time. The reality is, it will take up a huge amount of your time. And this, again, is another reason to have a really good team and really good co-founders working with you, because you want to make sure that there are people who can continue to run the business while you run the fundraising process, because your process will get in the way of running the business. And this is what we see. You think you can do both two things equally. The reality is fundraising effectively takes over a huge chunk of your life, and your ability to execute and focus on the business is diminished. And that's why kind of, having extra people around who can help, who can support, and who can run the business is important. And then if you're lucky, you get to go and work in some crazy co-working space and grow and scale your business and have hammocks for your staff. The other thing I would say is have a backup plan. Raising capital is difficult. It takes a long time, and it is important that you have some sort of plan to protect yourself and think about generating revenue for the business, or ways of generating revenue for yourself, because even companies who raise a seed round, they don't always make it to an A round. Companies who raise an A round don't always make it to their next round of funding. So it's raising capital, again, going back to kind of, do you need VC? Raising capital is no guarantee of success. It is just one signal and one way of thinking about success. So having a backup plan and understanding what it is that you can do to kind of keep the lights on is very important. So last slide for me, and then I'm going to get into a bunch of questions. Some things to be aware of, right? So competition is really important, and maybe you don't have a direct competitor who's doing exactly the same thing as you, but you almost certainly have some people who are doing similar-ish things to what you're doing. So never say that there's no competition. To me, it just seems a bit naive. Be wary of people who want to, what they call tranche investments, which is where they'll say they'll give you $50,000, but they'll split it into 5 monthly payments of 10,000, and each payment will be triggered by hitting a certain number or milestone or something else. The risk with that sometimes is you can sign an investment agreement, and then after 3 months of paying, the investor will run out of money or run out of interest, and it can leave you in a very difficult situation. So ideally, if you can raise investment and get the full amount into your bank account ASAP, that's good. Don't ask investors to sign an NDA. It's very difficult for us to do it because we see so many pitch decks and so many ideas and meet so many entrepreneurs. So it's hard for us to even consider doing it. It also doesn't get the relationship off on a good foot if you're saying, I don't really trust that you. I think you're going to share information about me with other people. That's not a good way to start a relationship. If you are building something that is using artificial intelligence or machine learning, be prepared to back that up when we ask. The same is true of companies building on the blockchain. We see a lot of companies saying they're doing something, building a company is Uber on the blockchain, or it's, AI powered dog walking software. Speaking in jargon and being complicated and lying is not a good thing. So if you aren't doing AI and machine learning, don't say that you are. If you're not doing blockchain, don't say that you are, because we will ask and we will find out. Don't use jargon. So no one likes to feel silly or dumb. And if you know more about your subject area, which you almost certainly will, than any investor, don't kind of try and baffle them with jargon. You'll just make them feel silly, and they'll be less engaged and less enthusiastic. And don't lie. If you don't know the answer to a question, when we meet in Istanbul and I ask a question you don't know, just say, I don't know. And here's the best thing: saying I don't know gives you an opportunity to contact me again. So you say, I don't know, but maybe I could take your email address, and when I talk to my tech team, I can come back to you with an answer. So don't bullshit, don't lie, don't make stuff up. Use the opportunity. Not everyone expects you to be perfect at everything and know everything. Use those opportunities to build a relationship. Um, these are my contact details. So these answer some of the questions already. Someone asked kind of how do we submit our company for Techstars. You can go to apply.techstars.com and you can get some details of forthcoming programs there. We'll be opening applications for about 10 or 12 programs at the middle or end of July. So you can submit your application that way and pick the program that you want to work on. So got a couple of questions to get to. So the one on the screen here from Gada Kadu. How do we convince an investor to fund us just to experiment on our product? The challenge that you have here is investors very rarely will do that. I think a lot of investors will expect people to use their own time and energy and money where they can to experiment on a product. I think if you've got a very solid team, a very solid background in a specific area, and it's a very complicated product, like maybe IoT or hardware or a medical device, I think you can use that track record and your credibility to get some funding to experiment. If it's a digital product like an app or a website or anything like that, or if you maybe don't have that kind of same level of expertise or unfair advantage, it is very difficult to get investors to fund experimentation and innovation. I think if you're looking for something that's really complicated, then I would see if there are partnerships you can do with universities, if there are government grants potentially that are available to support innovation, if there are ways that you can collaborate with other people. I think a lot depends on what the company is and what it's doing, but for the most part, one of the big challenges is, and one of the reasons that kind of Kickstarter and Indiegogo and those platforms exist is it's historically been very difficult to get investors to fund just an idea or kind of to fund people's experimentation, because it's very difficult to see what the return on that will look like. So I think that's a tough one, unfortunately. But I think if it's very technical, then I would encourage you to kind of look at opportunities that exist to collaborate with other people. How do we do pre-revenue startup valuations? Asks Siddharth. I think mostly it's we kind of back to what I said about understanding how much the company needs for a given period of time, and then understanding how much an investor is going to want from that company. It is very difficult to price a company that's maybe pre-product or pre-revenue, which is why from a Techstars perspective, we have a kind of one-size-fits-all deal where it's, we value every company that comes into our program at $3 million, and then they can kind of grow from there. And it's, the same for a lot of other accelerators. And it varies market by market. So for example, in some markets, investors will want a bigger share of your company, and so the valuation will be a little bit lower as a result. So there's no hard and fast rule, I'm afraid. It's mostly a little bit of guesswork, a little bit of trying to price in the experience of the entrepreneur, trying to price in the experience of the team, the scale of the opportunity, etc. But there's no fixed way. Ali's question: how do you value a company? Just by turnover? It's a number of factors as you get later and later into your funding journey. So as companies start generating revenue, it does become a lot easier to start to think about their valuation. But typically, the valuation is a combination of lots of different things. It's the people within the company. It is the intellectual property and patents within the company. It is the revenue that company is generating. It is the traction and growth and trajectory that company has over time that you try and price in. So it's one of those things where there's no, unfortunately, there's no algorithm or there's no formula to kind of fix a price for everyone or valuation for everyone. It really depends. People value consumer-facing companies way different than they value to B2B facing companies. So it's a pretty mixed bag. Should I include the balance sheet? Asks Ahmed. I think it depends actually. what we normally say to people is you need to know how much money you're going to raise, which is really important. And then you need to understand what you're going to use that money for. And so if you say you're going to raise $100,000, I'd like to see in the financial information some breakdown of, are you going to spend $20,000 of that on a couple of developers? Are you going to spend 40,000 on marketing? Or are you going to spend 20,000 on design, etc.? So I like to see that breakdown of how you're going to spend money, because that's one thing that you can predict as an early stage company, as an MVP stage company. I think you can do some financial projections, but I would not necessarily include them in terms of revenue, because mostly it's made up. It's a work of fiction when you're trying to figure out what your revenue is going to be in MVP stage. So I would much rather understand how you're going to spend the money that we give you, and then understand what's your plan in terms of the business model and revenue model, rather than kind of trying to understand. We see companies that come to us and say, hey, here's what we're going to look like in 3 years' time. And you're going to go, well, I don't even know what you're going to look like in 3 minutes' time or 3 weeks' time. So, doing revenue projections that far out is tricky. What are the criteria we should apply for when we've only built the MVP? I think, again, that's team and unfair advantage and founder market fit. So if you're at a very early stage, in terms of a prototype, I would be thinking, is this a brilliant team? Are they going after an area that they understand really well, that they have some unfair advantage in, that they have connections in, that will really help them grow and scale this business? Is this a product that is getting some attention and PR and some folks talking about it, either using a very simple landing page, or using some very simple tools to kind of be able to gather data on users and potential users. So I think you can kind of manufacture some momentum, but I think fundamentally we would look at kind of the team when you're at the very, very early stage without any revenue. Anthony asked, when's the best time to start paying the founders? As soon as you can, I think is fair. I think everyone has to take a salary and everyone has to make a living and pay for food and getting around. And so I think for founders, when you raise capital or when you start generating revenue, you should always be thinking about how do you make sure that you give yourself enough money to live on, but you don't give it so much money that you get demotivated. But I would say as soon as you have the revenue coming through the door, or investment money coming through the door, that's the point at which you start paying the founders, and you pay yourself a reasonable salary. Like, don't go crazy. Team is good. It depends. I mean, again, looking at the batch that's here now, we've got everything from 2 people to 10 people. So there is no kind of perfect size. What does an ideal team look like? It depends on the business. It depends on the people. It depends on the skill sets. Ideally, you want to have at least one person who can do the technical implementation. So if you're a hardware company, you want to have someone who can do industrial design or product design or manufacturing. If you're a software company, you want to have someone who can do the design and build of your software package or your platform. If you're an AI company, you want to have some machine learning and data science people involved. You also then want to have someone who has some sort of business ability and acumen, who can go out and me close deals with potential partners, get involved in lots of different things. So I think those are the most important things. But generally, if you're building a product, you want to have people who can look at design, who can look at business and marketing, and who can look at build. Do we invest or support with mentorship, guiding and supporting how to open new markets and then go further? Like, yes. So to Ali's question, for example, with SendGrid, we had people from Techstars on the board. We did a lot with them to help them open up new markets and introduce them to various different people in the network when they came to new markets. So we've supported companies at every stage of their journey, and we do a lot with companies who want to expand into whether it's into Europe or into the US or into Asian markets. we've supported companies as they've gone to IPO stage. So, I think we're kind of full service. What percentage should you keep in the option pool? Asks Majid. Again, it's pretty fluid, and it depends what stage you're at. We normally say to people, for your first round of funding, try and keep like at least 10% or 12%. It's a requirement. So if you want to do Techstars and you want us to invest in you, you have to have a 10% at least option pool. Because it's important to be able to incentivize those new staff that are potentially going to join during the program or after the program. When you raise subsequent rounds of funding, your new investors may require you to increase the size of that option pool if they feel that you maybe need to bring in some more key hires or executive hires. So, but at least 10%, I would say, is what you want to keep in there. And options are tricky in different parts of the world. In the US, everyone understands them and wants them and asks about them. We know in a lot of markets it's very different. People want a salary and they don't maybe see the value of equity or options. Shay asks, are friends and family ideal for startups? I'm guessing you mean it in terms of investing in startups. So yes, in some respects. Typically, people did a kind of friends and family round when they started fundraising and got some money from some close family members or friends to help them grow and scale. And it can be a very easy way to do things if you have friends who have the ability to help and support you in that way. I think one of the challenges of doing a friends and family round is if the company, I think you have to explain to those people that there's no guarantee of success, because the last thing that you want is to take money from your friends and family for the company to not work, and then for you to have to see them at family events and occasions for the rest of your life. So just be wary of it from that perspective. Like, never take money from people who can't afford to lose it. Is getting a loan a good idea for a startup? Again, it depends on the amount of the loan and how you're going to use it. I mean, I think if it's an amount that you can pay back relatively easily, it's probably not a terrible idea. But one of the challenges is the success rate for startups is relatively low, which is why so many of them look for investor money rather than money from the bank. So getting a loan can be good for a startup, but actually getting the bank to give you a loan can be extremely difficult and very time consuming. Nelful has asked, do the team have to focus working on the startup, or can they be a part-timer? I think in the early stages, very early stages, you can be a part-timer. I think if you want to come and do a Techstars program, or if you want to raise investment from an angel or a VC, then they are going to want you to commit fully to the company, commit fully to working on that, and so at that point, I think you can't be a part-timer anymore. I think if you're growing the business organically through revenue, you will probably know when that time comes, because you will start having more work than you can handle. Is it necessary to have co-founders of your startup? No, not necessary at all. I think it helps. It's good to have other people with other skill sets that can support you. I think it's great to have other people who can be good at different aspects of the business that maybe you aren't as good at. How do I search for co-founders? I'd strongly recommend going to a startup weekend. You can just go to startupweekend.org, take a look at your city or country or region, and you'll see when the next ones are scheduled, and you can meet some great people that way. What's the best equity rate to give to investors at the beginning of the startup? I think if you're going to do an accelerator like ours, then it's probably 6, 8, 10%. If you're going to do a bigger raise, then it's probably somewhere between 15 and 30%. If you're thinking about advisors and that side of things, then it's probably like a 0.5% or a 1/4%. But you don't want to obviously give people so much equity that it becomes a kind of it demotivates you. So I think you've just got to balance that out. Your budget from bootstrapping and yet to get funds from investors, what's the best thing to do? I think this is a very difficult one to think about, because I think there does come a point where you have to think, okay, well, do I go back and do some contracting? Do I take on some part-time work? Do I try and do a whole bunch of other things in order to keep this company on life support or keep it alive? Ultimately, I think every company and every individual has to make that call for themselves. There are times when you do have to hold your hand up and go, this isn't working, and maybe it's not your fault, or maybe the stars have just not aligned in the right way for the company or the founders. There are other times where actually you think, you know what, I want to keep going, and I can take on an extra job and make some additional money and continue to fund this startup. So ultimately, I think you've got to base it on how much enthusiasm are you seeing from people. If you're running out of money, are you running out of options in terms of investors? Are you running out of options in terms of clients and partners? I think those are difficult things that make you wonder, should you make the decision to take a break or step down for a little while. Lawrence, a book on fundraising. I think there's a really good book called Venture Deals by my colleague Brad Feld, which is all about kind of the investment process and how that works and the kind of legal terminology and all of those things. So I think that's incredible and gives you a really good overview of how this whole process works. So I would strongly recommend that one. Can small businesses serve as good investors for startups? They can. I think it depends on it depends what do they want to get out of it. Are they investors in terms of are they looking for a return? What's their kind of view on working or collaborating together? How much financial pressure are they under as a result of investing in you? Small businesses are great, but maybe they can't give you as much support sometimes, or if they face a cash crunch themselves, you may find yourself in a situation where they're saying, well, we don't have any more money to give you, or we can't support you. So just be wary of that. What are things to look out for before launching an e-commerce website? E-commerce is tough. You've got to make sure that you're selling products that people want, that you've got the supply chain and logistics correct in terms of delivery time, that the delivery process is relatively painless for people, that you can get adequate stock of actually stuff that people want. I think all of those things are incredibly important, and obviously for an e-commerce site, you've got to make sure that you're selling something that people actually want to buy. Syed, do we have something like the Startup Visa program like we have in Toronto? Yes, we work with the Home Office here in the UK and in many other countries around the world to support overseas entrepreneurs who want to come over and do our program. So yes, we work with you, and as we have with the companies who come in from India and Ukraine and elsewhere for this Next London program. Webinar will be accessible. I can see it's being recorded, so it'll be somewhere. So yeah, you should be able to watch it again if I go.
So Eamonn, thank you very much. Taking your valuable time and answering lots of questions. Still, there are lots of questions unanswered, but it is nearly an hour. So we were very happy to host you online in our webinar program, and we'll be happy to see you in Istanbul. And I will also share some of the startups before you come to Istanbul if you have time to mentorship. It will be great to get a mentorship from you as well. So we will be working on all the startups and entrepreneurs in next months in order to make them not only their presentation better, but also making their business models and also better kind of businesses in their countries. So thank you very much, folks, all the attendees and participants and entrepreneurs. Today was a great interest on the Eamonn's webinar. 100 people were all the time online listening to you. And for the questions, yes, we will be publishing this video as soon as possible. I think tomorrow it will be on YouTube, and you will be able to watch it again, and we will email you the link as soon as we upload it to the YouTube channel. So have a great day and night all over the world.
Good to chat to you.
Thank you. Bye bye.